So Brexit-related stock building and other temporary factors are causing significant volatility in quarterly GDP growth, but actually a range of activity indicators suggest that the growth rate of the economy is now close to zero, which is a combination of business investment declining outright, mostly as a result of that high Brexit uncertainty, and consumption growth slowing. The weak pace of underlying GDP growth is likely below the economy's potential now, which is an important change relative to the period, say, 2013 to 2017, when growth was clearly above potential. So in other words, previously the amount of economic slack was being reduced year over year, whereas this year it's probably increasing again. And the chart on the right showing you a decline in vacancies relative to unemployment also gives you some flavor of that. And an environment where the amount of economic slack is increasing again, that has a significant impact on the monetary policy outlook. So as we have said many times before, the nature of Brexit, as well as the evolution of the global economy, will continue to be key determinants for the UK outlook. And I continue to think that it's useful to consider in broad terms 3 possible scenarios. A near-term Brexit deal that reduces uncertainty and gives businesses adequate time to prepare for any future changes to the UK-EU trading relationship might yet stimulate investment sufficiently to prevent the need for easier monetary policy and put gradual and limited rate hikes back on the agenda eventually. A scenario of entrenched Brexit uncertainty is likely to keep economic growth below potential and require monetary stimulus. And finally, a no-deal Brexit is more likely to require stimulus than tightening, but given that all of supply, demand, and the exchange rate are likely to experience significant declines, the direction for interest rates is not automatic. We'll probably know more in the coming weeks about which of these scenarios will prevail. And in all 3 scenarios, the MPC will take the necessary action to bring inflation back to its 2% target from above or below while supporting growth and jobs.